Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Rajesh knows how to make your Mumbai sandwich experience count, and he's been making sure of it for over 8 years now on the footpath across our office. It's a tough life waking up at 5 a.m. to prepare for the day, which usually entails working for over 17 hours almost 365 days a year. But Rajesh has always had a dream to move from the street to his own licensed shop, for which he has been saving all these years. But even so, it's not been enough. Up until now, or so he believes. Last week, Rajesh opened a Demat account to invest in the upcoming IPO of Life Insurance Corporation of India. Now Rajesh expects that he'll make so much money in the IPO that he would be able to finally start his own sandwich shop. And just like Rajesh, thousands of investors have high hopes for this IPO, some of which may be quite misplaced. There is a lot of irrational exuberance about the issue, but on a closer look, there are a lot of worrying spots as well. Keep watching this video to know more. Hi, this is Yazad, and I'm so glad you're here today watching this. The much awaited issue of the state-run insurance behemoth LIC is set to open on 4th May for subscription. For many Indians, insurance is still synonymous with the company. Even today, LIC Karwai is commonly used as a synonym for purchase insurance in India. With the LIC IPO fever gripping the country, there are many investors who want to participate in this frenzy, and there has been a surge in the number of Demat accounts being opened by first-time investors. Remember the days when the much sought-after Reliance Power Mega IPO hit the market in 2008? Brokers' offices were kept open day and night to facilitate investor subscriptions. However, the bitter aftertaste of that experience left many investors wary. Now, similar excitement is currently being seen with the LIC IPO. Of course, a striking difference is that LIC is a robust company with a very strong track record. Even before the opening of the issue, LIC is commanding a grey market premium of 50 to 60 rupees, which is a decent premium for such a large issue. In a good market environment, it is very likely that the company may post good listing gains. Nevertheless, investors must be aware that the business of insurance is long-term in nature. If you look past all the current hype and exuberance, the burning question is, will LIC deliver in the long term for its shareholders? Analysts have questioned the timing of the IPO of Life Insurance Corporation, as it will test India's capital markets at a time when about $5 trillion has been wiped out from global equities in recent months. After the revised pricing, LIC's cheaper valuations compared to peers is a positive, particularly for investors seeking listing gains. However, there are significant risks for long-term shareholders investing in the company. One of the major concerns for long-term shareholders is that the company may sacrifice its interests to meet the goals set out by the government, its controlling shareholder. LIC has admitted that at times its actions at the behest of the government could be contrary to the shareholders' interests. In recent years, LIC has been a key buyer of shares in state-owned firms sold off by the government, often bailing out less than successful public issues of shares. In 2012, LIC bought 84% of shares on offer of the ONGC stake sale. In 2013, the insurance giant picked up over 70% in the sale disinvestment. In 2015, LIC picked up almost half of the shares on offer in Coal India's 22,500 crore disinvestment, once again coming in to ensure success of a government stake sale. And in 2018, LIC once again bailed out the initial public offerings of Bharat Dynamics Limited and Hindustan Aeronautics Limited. LIC has also been roped in to rescue struggling financial institutions facing bankruptcy. In 2019, it took over troubled IDBI Bank by infusing 21,600 crores for a 51% stake using its policyholders' funds as the government struggled to find a viable buyer for the bank. Over the years, LIC has also picked up stake in other state-run banks like Punjab National Bank, Corporation Bank, Allahabad Bank and State Bank of India, as the government struggled to adequately capitalize these banks in line with the levels required by the RBI. The government's dependence on LIC has been increasing over the last few years, and in effect the insurance behemoth has become the lender of last resort to the government. LIC has invested 10.7 lakh crores in the public sector since 2014 under the NDA government. In contrast, LIC's cumulative investment in the public sector was 11.9 lakh crores up to 2014. In effect, the company has invested in public sector in just 7 years 90% of investments that LIC had made in them during the previous 6 decades. Some analysts are drawing parallels of LIC with Coal India, which made its market debut in 2010 and despite being a monopoly, has lost over half its value till date. In 2014, about 4 years after it had invested in Coal India, the Children's Investment Fund, a UK-based activist hedge fund, had exited from state-owned Coal India as it had concerns over what the majority shareholder was doing. It is very likely that LIC could face similar resistance from its shareholders, which does not bode well for long-term valuation. LIC is the 5th biggest insurer in the world, and assets under management of LIC are over 3 times higher than all private life insurers combined. Even then, the company has been consistently losing market share to private players. Currently, LIC holds 64% market share in terms of total life insurance premium. But that is set to continue declining over the years, and this is evident by the fact that it grew at a CAGR of 9% over the last 5 years, while private insurers grew at over 18%. First, let us quickly understand how LIC operates. Up until 2021, 95% of the surplus generated by the company would be distributed amongst policyholders and 5% would be given to its single shareholder, that is the Government of India. But the company changed this in September 2021 in line with other private players. Now LIC has split its life fund, that is its surplus funds, into 2 categories: participating policies, which is 70%, and non-participating policies, which is 30%. Participating policies are those where bonuses are distributed. On the other hand, non-participating policies comprise of ULIPs and other guaranteed plans. As per the new method, from the participating policies, 90% of the 70 rupees, that's 63 rupees, will be distributed to policyholders, and the balance 7 rupees will be available for shareholders. Additionally, the entire share of 30 rupees from the non-participating policies will also be available for shareholders. However, it is very important to note that as compared to private players, this share of participating policies at 70% is still much higher, which means that there is that much less available for the company's shareholders. Let us look at some key financial metrics and see how LIC is doing as compared to its peers. If you look at the commission ratio, it is higher than private players. The percentage of new business brought in by individual agents is also exceptionally high at 93.8% as compared to an average of just 22% amongst its peers. This is because the company is very heavily dependent on agents for its sales. LIC's 1.36 million agents generate over 90% of the premium income, but over the last few years, the company has lost market share as it has been unable to capitalize on the digitalization trend and woo investors who prefer buying online. Between June 2020 and January 2022, LIC's market share fell from 74.04% to 61.4% in terms of premium income. It is expected to continue losing market share as private players have established strong online channels. Just 36% of individual renewal premiums are collected digitally for LIC compared to over 90% for private players. Private players have quickly grown their market share as opposed to LIC's agents who found it difficult to approach prospective customers amid lockdowns following the outbreak of the pandemic in 2020. A persistently weak digital presence could keep costs high as agents typically receive high commissions. Total expenses, including commissions paid to agents for LIC, has been steadily worsening from 28,331 crore rupees in FY19 to 34,425 crores in FY 2020 to 35,162 crore rupees in FY 2021. Another key parameter wherein LIC fares poorly is the value of new business margin. The value of new business is used to measure the profitability of the new business written in a period. It is the present value of all future profits to shareholders measured at the time of writing the new business contract. The VNB margin of LIC is just 9.3% as compared to the average margin of over 25% amongst its peers. Compared to private insurers, the bulk of LIC's sales come through its savings and investment plans instead of pure insurance products. This reduces the VNB margin because the company has to provide returns to policyholders of such savings plans as opposed to term insurance plans which are purely insurance products. Now, with more awareness and increased participation in the equity markets and mutual funds, investors are choosing to separate their insurance and savings requirements. This has spurred a rapid growth in pure insurance plans, and going forward, there may be less demand for investments and savings plans sold by LIC. Finally, if we look at persistency ratios, LIC has the lowest persistency ratio of 78.8% against the industry average of 85.13%. Persistency ratio is the number of total policies that an insurer has to the policies that are renewed or in force. It means lesser number of policyholders are choosing to renew their policies purchased from LIC. Changing customer preferences and market trends for life insurance products may change, and LIC doesn't seem to be in a position to respond appropriately or in time to sustain its business or market share in the future. As investors gear up for the mega initial public offering of Life Insurance Corporation of India, a niggling worry for them should be the low appetite for stocks of insurance companies amongst investors. Interestingly, none of the life insurance companies in India till date has seen a bumper listing, but even more importantly, none of the companies have really added significant gains since listing. ICICI Prudential Life Insurance Company Limited tumbled 11% on market debut in 2016. The stock, which was issued at 334 rupees in September 2016, is currently trading at 526 rupees, which is a CAGR of just 8.5% over the last 5 years. HDFC Life Insurance Company Limited listed with modest gains of just 7% over its issue price in 2017. The stock has been in a downtrend since September 2021, having fallen as much as 23% since then till date. SBI Life Insurance Company Limited, the country's largest private insurer, listed with modest gains of just 5% on its debut. Trading at levels close to 1100 rupees currently, the stock has grown at a CAGR of 10.5% since 2017. Clearly, insurance stocks have underperformed over the last few years, and this is not very encouraging for investors subscribing to the LIC issue. Investors should carefully consider the risks before investing in the IPO. After all, life insurance is a competitive industry, and despite LIC being the market leader, it is competing with over 24 private companies which offer better service and are far more advanced in terms of technology. The company has been losing market share consistently, and this is expected to continue. LIC has built a massive fund and an impressive renewal premium book over the last 66 years. However, at some stage in the future, these advantages will go away and private players will catch up. An example of this is UTI, which had near monopoly in the mutual fund business. Today, UTI has been pushed to the 8th slot in terms of assets under management as private players have taken the lead. Another concern is that the company has to abide by rules and regulations laid out by the government, which puts limitations on the growth of the company. LIC is also sitting on a mark-to-market loss of 6,028 crore rupees. In its draft papers, the company said that of the 11,265 crore rupees worth of debt papers of mispriced insurance policies, papers worth 5,351 crores are non-performing assets. Full provisioning has been done for these NPAs at an amortized cost, and if this transaction is shown in the balance sheet, LIC would have to show a loss of 6,028 crore rupees. Now it remains to be seen how LIC will adjust this MTM loss in its balance sheet. Finally, the LIC IPO is said to be the biggest issue in the history of Indian capital markets. If we look at the 9 biggest IPOs till date, surprisingly, 7 of them have failed miserably, with an erosion of as much as 97% of investors' wealth in one case. This track record is not a great precursor for the upcoming IPO, and investors should take note, particularly given the lackluster performance of several PSU offerings over the last few years. Now, will all these factors dampen the LIC IPO? Will the stock list with significant gains? And will LIC be a winner in the long term? We'll just have to wait and watch. That's all we have for this week. As always, thank you very much for watching. I hope you liked this video, and if you did, please share it if you feel it can help someone else. This is Yazad signing off. Until next week, happy investing. Goodbye.